Welcome to video lessons on IGNOU MBA. This is course number 4, Accounting and Finance for Managers. In this video, we are going to see unit number 1 in block number 2. Block 2 is about understanding financial statements. Unit 1 is about balance sheet. Let us begin unit number 1. This is the unit number 1, Construction and Analysis of Balance Sheet. In this unit, we will be studying the following topics: conceptual basis of a balance sheet, constructing a balance sheet contents, form and classification of items. Let us begin the unit. Balance sheet is concerned with reporting the financial position of an entity at a particular point in time. This is very important. It gives the picture of the financial position only at that point of time when we are taking the statement. This financial position is conveyed in terms of listing all the things of value owned by the entity and also the claims against these things of value. The financial position given by the balance sheet will be in the terms of items which are owned by the entity and claims against those items. They are going to be called, as we see further in this chapter, these are called assets and liabilities. Okay, the position as represented by the balance sheet is valid only until another transaction is carried out by the entity, which means if any further transactions happen after giving the balance sheet values will be changed. Okay, now let us understand the conceptual basis. What are the concepts used in the balance sheet? Like what is an asset, what is a liability, what is owner's equity? All these things we will be seeing with the help of an example. Suppose someone wants to purchase a car of cost 8 lakh rupees. He doesn't have money and he has to borrow from a bank. The bank says, if you can invest 3 lakh rupees on your own, we will give 5 lakh rupees. Okay, then the bank will ask these questions: what are the things that you have now, the things of value that you own, or how much how much do you owe to others? These are the questions will be asked by the bank. Then we have to prepare a financial position statement at that point of time. So for example, the person is having a balance in the bank of 3,50,000, fixed deposits of 1,50,000 and other personal belongings or other assets of 5 lakh rupees. Total, he is having items of worth 10 lakh rupees. He is also having a loan from a friend of 1 lakh rupees. Therefore, his net worth or the claims against his total items will be 9 lakhs. 10 lakhs minus 1 lakh. This 9 lakhs is called the net worth. So this financial statement prepared will also contain the own claim or net worth, which is of 9 lakh rupees. Now the bank grants him a loan of 5 lakh rupees and he decides to buy the car for 8 lakh rupees. After the purchase of the car, the financial statement would look like this. The balance in the bank is reduced to 50,000 because 3 lakh rupees is given as cash. Fixed deposits remain same, 1,50,000. Car, a new asset came to him, that is a car of value of 8 lakh rupees. Other personal belongings or other assets 5 lakh rupees. His assets are increased to 15 lakh rupees. This personal loan is already there, here 1 lakh. Now he has brought new loan from the bank 5 lakh rupees and his claim still remains the same. There is an increase in asset on the left side, there is an increase in the liability on the left side, on the right side. That is loan from the bank. Therefore, total liability is 15 lakh, total assets 15 lakh. Now what are assets? Accountants use the term assets to describe things of value measurable in monetary terms. All those items which have value in terms of money, they are called assets. Okay, what are liabilities? The amount owned by an entity or individual which represent claims against it or his assets by outsiders are liabilities. Okay, claims against the things of value or assets is known as liability. Claims by outsiders is called liability. Claims by owners is called owner's equity. The assets owned by the entity less liabilities or outsiders claims is the net worth. As we have seen here, the net worth is 9 lakh rupees. Since the net worth represents the claims of the owners in the case of an entity, it is referred to as owner's equity. Now we'll see the comparative financial position statement before and after purchase of the car. Before purchase of the car, the person is having 3,50,000 rupees as cash and he paid 3 lakh rupees for purchase of car. Therefore, cash reduced to 50,000. Right. Fixed deposits remained same. A new asset is increased after purchasing the car. That is, car of worth 8 lakh rupees is increased. Other personal belongings like some other assets, jewelry, gems, gold, all those things are maybe, for example, they amount to 5 lakhs. His total value of assets is 15 lakh rupees. Earlier it was 10 lakh rupees, now increased to 15 lakh. 5 lakh rupees increased. Now, after and before and after purchasing of car, his liabilities would look like this. Personal loan from friend, it is same, it has not changed, still 1 lakh rupees he has to pay. Mortgage loan from bank, so liability increased. He has brought loan from the bank of 5 lakh rupees. Net worth also remained same, 9 lakh rupees. Here also liabilities increased because of the loan from the bank from 10 lakh rupees to 15 lakh rupees. Okay. So what we understood here is assets increased by 5 lakh rupees, bank balance reduced, but another asset, car, came. So within the assets, one asset is increased, which is car, another asset is decreased, that is cash. Outsider's claim has priority over the owner's claim on the assets, and hence net worth or owner's equity is a residual claim against the assets. This net worth 9 lakh rupees is a residual claim on the assets. First priority goes to the outsiders. First he has brought a loan from friend, second he has brought a loan from the bank. These two will be given priority over the owner's claim on the assets. Okay, if the company is to be owned, first these persons have to be settled first, then the owner can claim. Okay, next, from this what the accounting equation is, assets equal to liabilities plus owner's equity, or in other words, owner's equity equal to assets minus liabilities. A position statement or a financial position statement which shows the balance between assets owned by an entity and its liabilities and owner's equity is referred to as balance sheet. This equation is the summary of the balance sheet. That is, assets equal to liabilities plus owner's equity. In other words, assets of an entity are always equal to the claims of outsiders and owners. Yes. Okay. The explanation for this equation is assets are equal to claims by outsiders and claims by the owners. Okay. Next, this equality enables us to reduce impact of all transactions in terms of the following possibilities. This equation, the above equation, is having these following possibilities. An increase in assets is followed by an increase in liabilities and or equity, and vice versa, which means if an asset increases, it means that either liability is increased or owner's equity is increased or both are increased. Okay. A decrease in asset is followed by a decrease in liability and or equity, and vice versa. Okay, this is all self-explanatory, you can understand. See the activity. An increase in assets in a position statement is possible when there is an increase in corresponding liability, or when there is an increase in the owner's equity, or a decrease in another asset also. Next, an increase in liability could result in an increase in asset, or decrease in another liability, or decrease in owner's equity. Outsider's claim against assets of an entity is called liability. Owner's claim is called owner's equity. Things of value to the entity are called by accountants as assets. Those items which have monetary value are called assets. True or false questions. An increase in asset always results in increase in owner's equity. Not necessarily. An increase in asset can also lead to increase in liability also. Assets equal to liability, so the statement is false. Assets equal to liabilities plus owner's equity is always true. Yes, this is correct. Outsider's claim against business is called a residual claim. No, owner's claim is the residual claim. Outsider's claim is the first priority. An increase in assets could be equaled by increase in liabilities. Yes, definitely. Losses result in increase in owner's equity. No, this statement we are going to see in the next topic. Profits would increase the owner's equity. Okay, this is a false statement. All assets in the balance sheet are valued at their realizable value. This is also false. Assets are always represented at their cost value. Okay. Next question, the fundamental accounting equation could be written as assets equal to liabilities plus owner's equity. Assets, we have to find out assets here. Owner's equity is there, liabilities is there. Add those two, we'll get 25,000 assets. Owner's equity is given. So assets minus liability, 25,000 will be the owner's equity. Liabilities you have to find out. Assets minus owner's equity, that is 70,000. Okay. Now constructing a balance sheet. The next topic is how to construct a balance sheet. Again, we will follow an example. Through that example, there are different transactions in this example. By one transaction, we will be understanding how to construct a balance sheet. Here we will be using the concept of business entity and many other concepts like conservatism, going concern concept. Business entity says that the owners are separate from the business. Okay. Now what is the first transaction in this example? Ram starts a store on January 1, 2003 with an investment of 2 lakh rupees from his personal savings. He decides to call his venture Ram Store. Okay. So this is the transaction 1. Someone invested into a business called Ram Store. Ram invested into his business Ram Store 2 lakh rupees. He has put cash into his business. This is the first day transaction. So at the end of the first day, his financial position or balance sheet would look like this. There is a cash which is an asset of rupees 2 lakhs and owner's equity or the claim against the cash, entire asset is by the owner, which is of 2 lakh rupees. At this point of time, only asset on the date of start of the business is the cash. There are no liabilities. There are no other liabilities. Entire claims and assets is made by the owner himself. Okay. See the second transaction. On January 2, the store purchases a shop. Shop means here an asset. He is bringing new asset. The store purchases, Ram Store purchases a shop for rupees 5 lakh by paying 1 lakh rupees cash. He has given 1 lakh rupees cash and signing a mortgage for rupees 4 lakhs. Means mortgage means it is like a loan only. His so 5 lakh rupees assets, he has got new assets 5 lakh rupees which is shop, and 1 lakh rupee cash is gone, and loan increased by 4 lakhs. Let us prepare the balance sheet at the end of the second day. So at the end of the second day, out of 2 lakh rupees, 1 lakh rupees cash is gone. So the cash balance would be 1 lakh rupees, and asset which is the shop is 5 lakh rupees. Liabilities, what are the liabilities on the second day? Loan, mortgage on the shop is 4 lakh rupees and the owner's equity is 2 lakh rupees. In the first day, at the end of the first day also, owner's equity is 2 lakhs, and the second day also, owner's equity is 2 lakh rupees. Here, the owner's equity is not changed because an increase in asset 5 lakh rupees is matched by an increase in the liability. Okay. Now see the third transaction. On January 3, the store purchased 50,000 worth of merchandise paying cash and 1,50,000 worth of merchandise on credit from Mr. Vanik. Okay, what is happening here? What merchandise means goods. Okay, stock of goods. He bought goods by paying cash. 50,000 rupees he paid cash and bought some goods. And 1,50,000 he did not pay. He bought goods 1,50,000. Value of this goods is 1,50,000, but he did not pay cash. That is on credit. He will pay at some point later. Okay. This now how would the balance sheet look after this? Earlier he was having cash of 1 lakh. Now 50,000 is paid in cash now. Therefore cash reduced to 50,000. Merchandise inventory. So the on credit he got 1,50,000. By cash he got 50,000. Total goods worth 2 lakhs rupees. So this is an asset. Goods is having no, that is inventory, merchandise inventory, that is an asset to him. Therefore 2 lakh rupees worth goods he is having now. Shop is also an asset which is 5 lakhs. Therefore his total assets increased to 7,50,000. Now accounts payable. This is what the goods which is brought on credit. He will have to pay at a later point of time 1,50,000. Mortgage on shop, which is the loan on the shop, 4 lakh rupees, and still the owner's equity is same 2 lakh rupees. Here assets are increasing, liabilities are also increasing. Therefore the owner's equity is not changing. 7 lakh rupees, 7,50,000 rupees assets, 7,50,000 rupees liabilities are there. The amounts payable on account of purchase of merchandise are called accounts payable or sundry creditors. Creditors means those who have given goods but have not received money from the company. The company is yet to pay money to them. They are called creditors. Usually these are short duration liabilities to be paid at the end of the normal credit period. Okay. Now what is the see the next transaction. On January 4, he sells half the merchandise. He is having merchandise of 2 lakh rupees worth and he is selling half of those goods, that is 1 lakh rupees worth goods for 1,50,000 rupees in cash. Means he is selling it for a profit of 50,000 rupees. Okay, apparently this transaction shows the transformation of an asset into another asset at higher monetary value, which means asset is getting cash, of 1,50,000 and reducing the assets to 1 lakh. This assets, merchandise is reduced to 1 lakh and cash is increased to 1,50,000. The change in assets is, there is a difference in the change of assets. So whatever is decreased, the same amount is not increased. An extra amount is increased, that is 50,000. That is called profit here. Okay, cash is increased to 2 lakhs rupees and merchandise inventory decreased to 1 lakh rupees. This amount of decrease is not equal to amount of increase in cash. Therefore, whatever is extra, that is treated as a profit. Therefore, that profit here will be going to the owner's equity. Earlier it was owner's equity 2 lakh rupees. Now it is 2,50,000 rupees. Okay, the increase in owner's equity is a result of increase in the assets arising out of exchange of merchandise inventory for cash at a higher monetary value, which is profit of 50,000 rupees. The amount realized from sales of merchandise is usually referred to as sales revenue. Whatever amount that is getting after sales is called sales revenue. Fine. Let us go to the next point. As a general principle, all assets are valued at their original cost. This is important. This is the cost principle. As a general principle, all assets are valued at their original cost. The increase in the owner's equity is equal to the profit earned out of trading, that is sales revenue. Normally it is profitable operation which increases the owner's equity. Thus, owner's equity could be understood as comprising of two parts, namely contributed capital and retained earnings. Okay, see, up to transaction number 3, we were having owner's equity as 2 lakh rupees only. In transaction number 4, there is a profit of 50,000 rupees and owner's equity increased to 2,50,000 rupees. Okay, the 2 lakh rupees is the contributed capital, 50,000 rupees is called the retained earnings or profits. Retained earnings is the profits earned and not withdrawn by the owners. This relationship, therefore, the owner's equity can be represented in another equation like this: owner's equity equal to contributed capital. In this previous example, it is 2 lakh rupees and retained earnings, which is 50,000 in the previous example. This is another equation, very, very important. So throughout these transactions, we are applying different concepts of accounting. They are dual aspect principle, like whenever asset is increased, liability is increased. Whenever asset is reduced, liability is reduced, like this. So if we are affecting the left side part of the equation, the right side part of the equation is also equally affected. Okay, all the figures are expressed in monetary terms, right? All the transactions we reflected were in terms of in respect of the business entity. Okay, business entity concept is used. Owner is separate from the business. Going concern concept is also used. It is assumed that business is going to exist forever, right? The next activity, balance sheet is prepared at the end of a specific period. This period is in accounting variously referred to as accounting period or operating period or financial year, any name you can call. Balance sheet prepared at the end of an year summarizes the balances in what? Assets accounts, liabilities accounts and owner's equity accounts. Assets on a balance sheet are usually grouped together as assets. Assets are grouped like current assets, long-term assets, fixed assets, other assets. This topic we are going to see in the next part. Okay. Claims against the assets on the balance sheet are summarized as current liabilities, long-term liabilities, owner's equity. Now we are going to see these two topics now. Balance sheet contents. What are the contents of a balance sheet? It may be clarified that there are two conventions in preparing the balance sheet. Two conventions are American convention and English convention. In the American convention, assets are written on the left side, liabilities are written on the right side. In between there will be a T form. T form table will be there like a T. If you write alphabet T, left side will be assets, right side will be the liabilities. That is the American convention. In the English convention, it will be interchanged. Liabilities will be on the left side, assets will be on the right side. Okay. Whereas for our convenience, for our understanding, easy understanding, in this book we will be following the American convention only. Assets on left side, liabilities on the right side. There is an example here. Okay. Form and classification of items. Classification of items in the balance sheet, like current assets, current liabilities, long-term assets, long-term liabilities. Okay, we'll see this. It is an accepted convention that the assets and liabilities are shown into subgroups and listed in the order of their liquidity. How these items are grouped in the balance sheet? They are grouped based on the liquidity. Liquidity means how easily items can be converted into cash. That is liquidity. Assets which are likely to be converted into cash very easily or within a year, they are called current liabilities or current assets. Okay, whatever item can be converted into cash very easily in the near future, before 1 year, they are called current assets. Similarly, liabilities which are due for payment in the short run are called as current liabilities. We'll see what are the different kinds of current assets that can exist in a balance sheet. Current assets are assets which normally be converted into cash within a year. Yes. Now, examples or types. Cash. Cash is usually taken to include currency, checks, or any other document that circulates as cash, DD also. Cash is usually classified as a current asset when it is available for a firm's day-to-day operation. Cash is a current asset. Cash can include check and DD also, or any other legal tender. Temporary investments. What is this? Temporary investments. Whenever firms have short-term excess cash, it may be invested in readily marketable securities like shares, debentures, and government securities. These assets are readily marketable and could be sold whenever cash is required. Okay, when there is an excess cash in the company, they can invest in shares, debentures, and government securities. These instruments can also be shown as current assets. Okay, they are shown at their cost value, cost price. These securities are usually recorded at cost at which they are acquired. The valuation rule says that you have to record cost price or market price, whichever is lower. Though it may look contradictory, this principle will be used. Okay, generally cost price will be lower. Why this principle is used? Because there is a principle called conservatism in the rules of accounting. It says that do not recognize any revenue unless it is realized. Any revenue or gain unless it is realized. So the value of the instrument will be realized only when it is redeemed on the future date. Okay, until then we will be showing the cost value only. Okay, when the firm values its securities or instruments like shares or debentures at cost or market price, whichever is lower, we say the firm is conservative. Okay, usually the cost price will be lower. That is, whenever presented with two alternatives, the firm chooses the one which shows the lower value of assets or higher value of liabilities. This is the gist of the conservatism principle. Okay. Next, accounts receivable. This is also a current asset. Accounts receivable means amounts owed to the company by debtors, those outsiders who have to pay to the company. They are called accounts receivables or sundry debtors. Someone outsider has to give money to the company. They are called debtors. They are also known as trade receivables. Okay. Company has made a trade, sold some items to some persons or some vendors, but they have not yet paid. They have to pay to the company. They are called sundry debtors. In most situations, these accounts are unsecured and have only the personal security of the customer. Okay, these are not long-term contracts or long-term selling things, but these are only for short-term. Okay. Provision. It is normal that some of these accounts default and become uncollectible. These collection losses are called bad debts. Okay. Company usually, by assuming a good faith on the vendor to whom it sold the items, normally it receives maximum of the amount, but sometimes a small portion will not be realized. It is not possible for the management to know exactly which accounts and what amount will not be collected. However, based on the past experience, it is possible for the management to estimate the loss on the receivables or sundry debtors as a whole. For example, in this example, see here, 10% is estimated as a loss. Out of 7,50,000 which is to be received by the company, 10% is treated as a loss or a bad debt. The company says that this is not going to come. This is also called as provision. Okay. The next part. It is a usual practice for debts to be evidenced by formal written promises to pay. Formal written promises to pay or acceptance of an order to pay. These formal documentary debts represent promissory notes, receivables, or bills receivable. Okay, whenever a company sold items but has not yet received amount, then it will be asking for legal documents or promissory notes. Those promissory notes are called bills receivables. Okay, debt which is backed by a promissory note, they can be traded and assigned to another party for realization. The company can give this promissory note to another person. Okay, you go and collect the amount from that person. I have already sold goods to that person. He has not yet paid amount to me. You take this promissory note and collect from him. So by this promissory note, the company can go to bank and collect and can get overdrafts or cash credits also. Okay. So just the next level of trade receivables is nothing but bills receivables. Okay, trade receivables with a promissory note is bills receivables. Right. Inventory is also current asset. Inventory is the merchandise held for sale. Stock of goods held for sale. The different kinds of stock of goods are like raw material, which are useful for production, which is used in the production, work in process, materials remaining at various stages of completion, finished goods, the end products, okay, and stores and supplies. These are all the inventory. These are also treated as current assets. Cost of the inventory. How cost of the inventory is arrived at? In trading firms and manufacturing firms, the derivation of cost is different. In trading firms, inventory costs include freight cost, transit cost, insurance cost, import duties, entry duties. Entry duties authorize sometimes entry into a particular district. The district authorities will impose outright duties, that is entry levels, and also invoice cost. These are all the costs of cost of inventory for trading firms, which does selling and purchasing. Okay, warehouse costs. There are other costs also. Warehouse costs, which is like storage costs, handling costs, insurance cost in storage, interest costs. These are all not included in the cost of the inventory. They are treated as expense. For trading firms, for trading companies, these costs like handling costs, storage costs, interest costs, these are all treated as expense for the firm. Okay, we'll see the manufacturing firm. In manufacturing units, valuation of inventory is more complex. So whatever is used in the production of goods, manufacturing of goods, they will be treated as inventory. You see, as a general rule, all costs of materials, labor, and plant facilities used for manufacturing the goods are included in the valuation of inventory. Okay, this is about inventory and cost of inventory. Prepaid expenses. Expenses made in advances are also treated as current assets. For example, insurance payment, subscriptions, taxes, rents, these are all amounts paid in advance, which is sometimes beyond the accounting period also. Whatever is beyond the accounting period, that is treated as the advance payment. Okay, they are called prepaid expenses. Why these prepaid expenses are treated as current assets means, if these advance payments were not paid, cash would be available with the company, which can be used as a current assets. But since they have already paid towards that insurance or subscription, this cash is not available. So that advance payment is treated as a current asset. Fixed assets. Fixed assets are tangible, relatively long-lived items owned by the business. Right. The benefit of these assets are available not only in the accounting period in which the cost is incurred, but over several accounting periods. Okay. In accounting, we are concerned with useful life of the asset. Useful life of the asset means for how many years this asset is useful to the business, or this business you can use this asset for how many years. Useful life is the period for which a fixed asset could be economically used. Economically used means using that asset, benefits can be derived for the business. This implies that the benefits from the fixed assets will flow to the organization throughout its useful life. Right. Another aspect of this is that the cost incurred in the period of purchase of the asset will be providing benefits over the useful life of the asset. What is this cost incurred in the period? We'll see here. Valuation of the fixed assets is usually made on the basis of original cost. Take the original cost of the fixed asset. However, since the assets have limited life, the cost will be expiring with the expiration of the life. A fixed asset, for example, say here it is given an example. See, delivery van at cost. The cost of the delivery van is 10 lakh rupees. This is an asset. The life of the van is 5 years. Okay, in 5 years, this van is becoming junk. After 5 years, this will become a junk. Therefore, every year, how much is useful? How much part of the value of the asset? How much value is useful for the company? That is called expiration of the life of the asset. Valuation of the asset is reduced proportionately to the expired life of the asset. Is if we treat equally, if we take 2 lakh rupees every year, 2 lakh, 2 lakh, 2 lakh, 2 lakh, 2 lakh for 5 years, then at the end of the 5 years, this value will become 0. This expiration of cost every year is called as depreciation. If the expiration of cost is given equally every year, that is called straight line method of depreciation. Fine? Right now, next, the value of the assets at cost is usually referred to as gross fixed cost. That is 10 lakhs in the above example. And the amount of depreciation up to date is the accumulated depreciation. For example, after 3 years, the accumulated depreciation will be 2 lakhs, 2 lakhs, 2 lakhs, 6 lakhs. Net value of the asset is usually referred to as the net fixed assets. Okay, that is the value minus the accumulated depreciation. For example, after 3 years, in the above example, it will be net value will be 4 lakhs after 3 years, right? Equally distributing the cost of asset over its useful life is called the straight line distribution of cost. Here, see, for example, 2 lakhs is equally distributed for all the years. This is straight line method of depreciation. Next, this is about the fixed assets or physical assets. Fixed assets normally include assets such as land, building, plant, machinery, and motor vehicles. All these items with the exception of land. Okay, you see, this is very important. Land is not subject to depreciation. Land values will always appreciate. Therefore, in the fixed assets, land will be taken out and it will be shown separately. Intangible and other assets. Intangible assets, those assets which are not existing physically, okay, they are called intangible assets. Intangible assets are things of value without physical dimensions. They cannot be touched. They are incorporeal, representing intrinsic value without material being. Okay. One of the most common types of intangible assets is goodwill. Remember this, goodwill. What is goodwill? Goodwill reflects the ability of a firm to earn profits in excess of normal return. Okay, this seems very complicated, but we'll explain this easily. Almost all firms may have some goodwill. However, they appear in the books and balance sheet only when it has been purchased. Okay, whenever a company is being purchased by another company, then only goodwill, the concept of goodwill comes into picture. Usually, when a going concern is purchased, the purchase price paid in excess of the fair value of the assets is considered goodwill. See here, price paid by a purchasing company in excess of the fair value of the assets of the company being purchased is called goodwill. The premium paid above the fair value of the worth of the company is called goodwill. Okay, goodwill is an intangible assets. There are other intangible assets also, like copyrights, patent rights, franchise rights. Okay, these are also intangible assets. They are also having limited useful life, just like the physical assets. The cost of acquiring such assets have to become expired costs over such useful life, which means after some years the value of these assets is going to be 0. Therefore, every year you reduce the cost, reduce the value of those assets. That is called depreciation for physical assets, and for intangible assets, that is called, this expiring of cost is called amortization. Depreciation for intangible assets is called amortization. Fine. We'll go to the right hand part of the balance sheet, liabilities part. Among these liabilities, they are grouped according to the liquidity. Whatever is due immediately in the near future, they are called current liabilities. Okay, these amounts are owned by the business. Current liabilities are amounts owed by the business. Okay, obliged to pay, owed by the business to people who have lent money or provided goods or services on credit. On credit means the company has taken goods and services but has not yet paid the money. Okay, if these liabilities are due within an accounting period or the operating cycle of the business, they are called as current liabilities. Okay, now we will classify the current liabilities in the terms of their relative liquidity. How easily, when they are due to pay. Like first is acceptances and promissory notes payable. Okay, this is also this is like trade receivables only, opposite of trade receivables, which you have seen in the current assets part. Acceptances are bills of exchange accepted by the firm, usually for goods purchased. Okay, similarly, promissory notes are written promises to pay the debts at a specified future dates. Already I have explained this one. This is understandable. Accounts payable. Accounts payable, if you want me to explain again, I will explain, no problem. Acceptances are bills of exchange accepted by the firm, usually for goods purchased. Okay, bills of the company is accepting bills of exchange. Bills of exchange means there is a promissory note, there is a guarantee given in writing. Okay, that bills of exchange, if the company is having, then it is sure that company is going to receive money from the vendors. Okay, these are to be, I'm saying the reverse part. Acceptances are bills of exchange accepted by the firm, usually for goods purchased. Okay, that is bills of exchange, correct. Promissory notes are written documents, legal documents. If such notes or bills are for longer duration than 1 year, then the portion which is due for payment during the current period alone is treated as current liability. Right, is understandable. Accounts payable. Accounts payable are sundry creditors, means amount which has to be paid to the outsiders, are usually unsecured debts. There is no guarantee for those debts. Okay, these are also referred to as payables on open accounts. They are not evidenced or guaranteed by any formal written acceptance like a promissory note. They represent credit purchase of goods or services, means that company is purchasing goods or services but amount is not paid now, for which payment has not been made as on the date of statement. They are called accounts payables, sundry creditors. Okay, accrued liabilities. This is also current liability. Accrued liabilities represent expenses or obligations incurred in the previous accounting period, but the payment for the same is not yet paid or will be made in the next period. Same. In many cases where payments are made periodically, like wages, rents, and similar items, last month's payment will appear as accrued liabilities. This is understandable. Rent, we will pay the rent at the end of the month. Okay, but if the accounting period is beyond that month, then we will show the rent as accrued liability. The expense is incurred in this current period, but it is not yet paid. Therefore, it is an accrued liability. Provisions are estimated liabilities. Okay, a liability which is estimated, when the amount is not known, it will be estimated. Okay, where the liabilities are known but the amounts cannot be precisely determined, then we will prepare estimated liabilities. For example, for income tax, if we do not know the exact amount of tax to be paid, then we will prepare an estimated liability. Okay, contingent liabilities. If we do not know the amount, if we do not know whether the liability will exist or not, then in such cases we will prepare contingent liabilities. Contingent liability is actually not a part of the balance sheet. It will be shown separately at the end of the balance sheet in the form of a footnote, in the form of a notes. Okay, for example, a court case. The company is not sure whether it will win the court case or not. In such case, the company will prepare to give the true picture of the firm. It will prepare a footnote. There is a court case, this much amount may be paid or this much amount may not be paid, because if we win the case we need not pay. Okay, these are our contingent liabilities. Next, long-term liabilities. Long-term liabilities are usually for more than 1 year. They cover almost all liabilities not included in current liabilities and provisions. Right, long-term liabilities are like debentures and bonds, borrowing from financial institutions and banks, debts. Okay, this activity. As a convention, items appearing on the balance sheet are listed in the order of their relative liquidity. Balance sheet could be presented in either in T form or report form, like one after the other in a line. Operating cycle is the duration. Operating cycle duration means what? This is the duration when the cash transactions happen. Okay. Temporary investments are valued in the balance sheet by applying the principle of temporary investment, conservatism principle. Temporary investments, their value will not be, their market value will not be shown in the balance sheet, only cost price. Okay, whichever is lower, that will be shown. This is the principle of conservatism. Accounts receivable are also referred to as trade receivables, sundry debtors. Those who have to pay to the company are called sundry debtors. Okay, expired cost with respect to a fixed asset is referred to as depreciation expense. Okay, expiration of cost of intangible assets, depreciation for intangible assets is called amortization. Sundry creditors are also referred to as, to those the company has to pay, they are called sundry creditors. Company has to pay to creditors. Okay, they are also referred to as what? Accounts payables. Account payable. Okay, we judge an item as a current asset if it is converted into cash during the current accounting period. Liquidity refers to nearness of an item to cash. Items classified as current assets are usually listed in the order of their relative liquidity. The basis of valuation as applied to temporary investment is, for temporary investment, the principle of conservatism is applied. That is the basis for the valuation. Generally it is the cost price which is taken. Market price will be a bit higher because interest will be added to those temporary investments like shares or debentures or some small bonds, short-term bonds. Asset losses expected out of non-collection of receivables are called, these are called provisions or bad debts. Okay, formal written or documented debts refer to promissory notes. These are guarantees. Items commonly referred to as inventory include raw materials, finished goods, stock in process. All these things are inventories. Inventory is usually valued on the basis of cost. Say, okay, we have completed assets and liabilities. Now we will see the capital. Okay, what is the capital? Earlier we have seen this equation, assets equal to liabilities plus owner's equity. Okay, in the previous example, we have seen owner's equity as 40 lakhs. If there are 4 owners, then this 40 lakh can be divided among them like 10 lakh, 10 lakh, 10 lakh, 10 lakh. This is the capital contributed by the owners. Okay. According to legal requirements, the owner's equity section of the company's balance sheet is divided into 2 parts. Share capital representing contributed capital and reserves and surpluses representing retained earnings. Okay, the owner's equity is, there are 2 parts in the owner's equity. First is the contributed capital or the initial investment. Second is the reserves and surplus, also called as profits. Okay, profits which are not distributed with the shareholders will be taken to reserves and surpluses. The contributed capital is the amount paid by the shareholders. Okay, this we'll see this. Share capital is the joint stock predetermined by the company at the time of registration, also called as authorized capital. How much amount the company is authorized to raise from the share markets is called authorized capital, which is it will be written in the registration document. It may consist of either ordinary share capital or preference share capital, okay, or both. What is the preference share capital? Preference share capital means there will be preferential shareholders who will be given a right to receive a fixed amount of dividend. Okay, fixed, they will be having a preferential right to fixed amount of dividend and repayment of capital first. Their priority will be first. If the company's liquidator wound up, they will be given the first priority to repay their capital. Okay, these are called preferential shareholders, and the capital produced by them, given by them, is called preferential share capital. This share capital stock is divided into units or shares. Thus, if company decides to have share capital, it could be either ordinary shares alone or ordinary and preference shares both. For example, see, authorized share capital. The company has an authorized share capital of 2 lakh rupees. Okay, the maximum amount that it can raise from markets is 2 lakhs. That is written in the registration document. This is divided into 2 parts, like 15,000 ordinary shares, 10 rupees each, means 1,50,000 rupees can be raised. 500 10% cumulative preference shares of rupees 100 each. So preference shares 500 are there, and each preference share is 100 rupees. Then the preference share, the dividend on this preference share is 10%. Cumulative means If the company not decides to pay the dividend, then this dividend will be accumulated, and whenever the company decides to pay, all those unpaid dividends will be accumulated and paid to the preferential shareholders. That is cumulative preference shares. Okay, the amount of dividend is 10%. Okay, if 500 preference shares are there, each is 100 rupees, costly. Okay, compared to ordinary shares, it is costly. So 50,000 rupees, it can raise 50,000 rupees through preference shares and 1,50,000 rupees through ordinary shares. This is the total capital, authorized capital. Okay, the portion of that portion of authorized capital which has been issued for subscription is called issued capital. Okay, for example, the company decides to sell only 7,500 ordinary shares. Okay, not the total 15,000, only half of the shares it wanted to sell. Then it can raise only 75,000 rupees of capital, and it decides to sell all the preference shares. Then it can raise 50,000. Put together 1,25,000. If all these sold shares are subscribed fully, then the total paid up capital will be 1,25,000. Then it is called subscribed capital, called up capital, or paid up capital. This 1,25,000 rupees which the company raised through these half ordinary shares and 500 cumulative preference shares, it is called paid up capital. The implication of authorized capital is that it is the maximum amount of capital a company can raise without changing the registration deed. Whatever is there in the registration, that is the maximum amount it can raise from the capital markets. Ordinary shares and preference shares. Preference shares are so called because they have some preferences over the ordinary shares. What are these preferences? Their preferences are related to repayment of capital. Repayment of capital is original amount which they have given to the company as an investment. Okay, and payment of dividend. This payment of dividend is a fixed dividend. Generally, it is fixed dividend, 10%, 15%, 20%. In the event of liquidation of the company or winding up of the company, the assets that remain after payments to the creditors. Whenever a company is wound, first payment will be made to creditors. Whoever given, they are also called debt contributors. Whoever given debt to the company, they will be paid first. Okay, and the remaining assets will be first given to the preference shareholders, and only at the last the ordinary or normal shareholders will come. They will be given at the last. Similarly, whenever the company earns profits and decides to distribute dividends, the preference shareholders are first paid their prefixed dividend, a percentage in preference share to the ordinary share. In preference to the ordinary shareholders means before the ordinary shareholders. Preference shares could be made redeemable after a specific period, and there are various types of preference shares. Redeemable preference shares, share in the profit can also be given. Okay, there are various types of preferences that can be seen in the other chapters. Similarly, the preference shares could be granted the right to accumulate unpaid dividends, that is cumulative preference shares. Okay, it is also possible to provide to preference shareholders the opportunity to share the excess profits. Okay, under the company law, it is not necessary that a company should have preference shares. Okay, it is the decision of the company whether to issue preference shares or not. Ordinary shares have no preferential or fixed rights with respect to either repayment of capital or distribution of profits. Okay, and one more thing, the company, it is the right of the company. Okay, also it is the company that decides whether to give the dividend or not. Preference shareholders or ordinary shareholders, they do not have any right to the dividend. It is the decision of the company to distribute dividend. Okay, however, in case of cumulative preference shareholders, whatever dividend is not paid earlier, that will be accumulated, and the company has to pay whenever it decides to give dividend in the future. Okay, now reserves and surplus. It is a surplus not distributed by the firm as dividends. In other words, these are profits decided to be retained within the business. The company decides not to give dividend and put the profits back into the business for expansion or growth or investment in further projects, then they are called retained earnings or surpluses. Okay, It is possible to allocate the profits earned and accumulated as reserves or retained earnings to be earmarked for specific purposes. The earmarked reserves are not distributed. Only non-earmarked or free reserves are available for distribution as dividends. Right. Okay, we'll see activity 4.7. Balance sheet is a statement of assets, liabilities, and owner's equity. Dash represents the owner's claim against assets of a business. That is owner's equity or net worth. Dash are the claims of outsiders against the business. Liabilities. Liabilities are the claims of outsiders against the business. Dash increase owner's equity. Profits. Profits, when the company decides not to give the dividends and put those profits back into the business, then owner's equity will increase. Amounts owed by a business on account of purchase of inventory are usually called sundry debtors or accounts payable. Okay, amounts receivable by a firm against credit sales are usually called what is this? Sundry debtors. Sundry debtors. Company has to receive money. As a general rule, all assets are valued at their cost. Owner's equity could be understood as comprising two parts. What is the first one is originally contributed capital. Okay. The second one is the retained earnings or reserves and surpluses. The dual aspect principle has a special relevance to. Dual aspect means when assets increases, liabilities increase or owner's equity can increase. This is applicable to balance sheet. All valuations in a balance sheet are based on the assumption about the entity as a continuing firm or going concern concept. Okay, this is a summary. There are some keywords. Next is self-assessment questions are there. This chapter is very important, not only from the point of view of examinations but also from the point of view of general understanding about the companies. Okay, assets, liabilities, these are very important for general understanding. So this is the end of this chapter. In the next video we are going to see unit number 2, construction and analysis of profit and loss statement. Until then, bye bye. Thank you for watching the video.